G'day there. Welcome to the closing bell on the 5th of November. Today, of course, we're going to be reviewing the Fed coming out and really jawboning the market down after their 75 basis point rate rise. There's been a lot of excitement recently, thinking, well, they must be getting close to slowing things down and reacting to some of the, I guess, forward or inflation indicators that have been saying that things will come off the boil in the next few months on the inflation front. But look, I got up at 5:30 in the morning and I was watching the press conference with Chairman Powell. And yeah, as he was chatting, it was pretty clear he wanted the market to know that they're not about to stop raising rates, that's for sure. And they've still got work to do. And the indicators that they look at aren't rolling over yet, and they're not going to really stop raising rates until the things that they really worry about turn over. So there's been lots of commentary saying, look, all the leading indicators, M2 growth is collapsing at the moment. We've got, forward indicators on rentals and things like that saying that they're softening. But the Fed was pretty adamant that those sort of indicators look at the edge of the market rather than what's really going on at the core. So, yeah, I think it's pretty much a state of indecision for the market for this next sort of 3 to 6 months while we just wait to see how these interest rates come through and how all the numbers start coming off on a growth perspective. So today I thought I'd show you a comparison between what the S&P's done and that 2-year, 10-year spread on the bonds, and just have a look at how markets have performed over the past few decades to give a sense of, how interesting the point is where we are right now with 2-year rates at 4.7% and, 10-year rates at 4.2%. So about 50, 60 basis points underneath where the short-term rates are, those 10 years. So real, negative sloping yield curve at the moment, which is, saying we're leading to recessionary type of situation. So I just wanted to show you how markets often perform as those rates move around the way they do, and then have a quick look at the S&P, because it is tipping over, isn't it? And looking a bit sketchy as far as all those lines in the sand I've given you recently. And the trend is definitely still down. So let's jump to the charts and see what we can see. So here is the S&P 500. You can see there, that black line going back to 1989. And we've also got this blue line, which is the yield of a 2-year bond. So that blue line is the yield on the 2-year bond, and the orange line is the yield on the 10-year bond. And the scale for that on the right-hand side, you can see there. And what I want you to notice is that relationship between the 2 and 10-year bonds and what happens as they raise rates, and the connection between the 2s and the 10s, where you've got periods where the 2-year yield goes sort of equal to or above the 10-year yield, which happens, once you've got rates rising quickly at a rapid pace. And have a look at sort of what's happened in stocks once you've got to that point. And look at where we are here. This is now rates rising very rapidly, and the gap between the 2 years and the 10 years now quite pronounced. So we're getting closer to that inflection point, aren't we? Often doesn't stay there that long before you get things tipping over again and yields then starting to come back off as you get an earnings recession or what have you. And I just want you to note, back in the 2000 to 2003 sell-off and the 2008 crash, to note that we reached that peak really prior to the sell-off beginning. And the real crash occurred over that period as rates were falling. So as the economy tipped over and things got really bad, then the Fed would react and lower rates rapidly, trying to get things going again. And again, with the housing crisis, they raised rates. You see the rates rising quickly there, going to the equivalent of the 10 years. So the yield curve getting flat. And then it was a while before, Bear Stearns, etc. And then going into Lehman just before the real part of the crash, but it was selling off for a year before Lehman hit. But you can see that the rollover in yields really happened as markets started to accelerate to the downside. So there's plenty of people, I think, wanting to, buy the market as soon as there's any sort of sign of an inflection, that people think that means this sell-off will be over and things will rally again. But the point being, if they raise rates too far and too fast and really over tighten, that the economy will come off the ball pretty rapidly and earnings will start to dump. And then you'll have, markets selling off due to earnings misses and going into a recession. And that's not really priced in. So I think just that excitement that the higher these rates go, the closer we are to what they're saying are that pivot, the market expecting that once rates stop rising and they get to the point where they're going to go flat, that just means rates will fall a bit, and that means stocks should just shoot back to the upside in that case. But, that may not be how things play out. If we go back, as I've been saying, that was not the case. Once things got ratcheted up too high, the economy fell over, stocks sold off as rates fell and really accelerated to the downside. The more rates fell because the Fed was chasing to the downside as things collapsed. So that's just one little statement that, even though we may get a nice bounce if the Fed starts to ease off again, it doesn't mean it's not going to then turn down and have that earnings recession and the next real wave before things bottom and can start rallying again. So let's have a look up close at that S&P. So here's that S&P 500 on the monthly basis. You should really know this pretty well by now if you've been following along with me. Looking initially just at the simplicity of moving average crossovers, the 10-period exponential versus the 20 simple, and noticing, apart from that little false signal there, how good it has been over the past few decades of picking out these trends: downtrend, uptrend, downtrend, uptrend, false signal, uptrend. So this is saying we're in the early stages of that downtrend. So that is saying that the state of the market has changed. My moving average convergence divergence, so looking at the relationship between the 10 period and the 20 and the distance between them, that's this MACD, and then you've got a moving average of that calculation, giving you a sense of, when it's bearish, and it can be quite early in giving you the indications that things are changing. So, in that crash period, there's the MACD negative, and it turns positive here. So it actually turns positive well before the long-term trend turned up. But you can see where we are now. There's nothing on this MACD saying that it's positive, is it? So this is still in that state of trending. And when it's trending, you're looking at that 10-month exponential is the first sort of line in the sand that the market needs to get above to prove that it's potentially trying to turn around. And you can see when it trends to the upside, that 10-month exponential can be great support. Just holding above it all the way. When it sells off, finding support at the 10 months, never closing on a monthly basis below it. And then the monthly close below that 10-month exponential, beginning of a few months sell-off, but the trend itself never changed. So from that point of view, when it is trending and the trend is up, you're watching that 10-month exponential And often you're finding support there, support, support, support. Once it cracks, then you're saying, okay, things may be about to change. They may not, but at least that's a weakening of the trend. But if you look at it from the point of view of where we are at right now, there's none of that, is there? We are still seeing resistance at that 10-month exponential. So that's what I'd call, a strong long-term downtrend. We're in that phase where it could go on a lot longer than you expect. So from that point of view, everything pointing down, monthly sell pivot, the most recent sell pivot, marching down with new key bars to the downside, negative, negative, negative. So nothing there saying really that it's going up. We're looking at the weekly buy pivot over the last few weeks, saying, it could bounce on the short term, but the long term still negative. So our line in the sand, the low of the correction for that S&P. So, down through 3,500, what happens below there? Really, it's this whole area. I guess I'm interested in 3,400 to 3,500. It can still sort of bounce from there, but below 3,400 is where it starts to set off my, real end of the very long-term uptrend. It's sort of big picture negative under there and can really get smashed pretty quickly. So from that point of view, everything is just shaping up from that negative point of view in the short term. And, maybe it is just 6 months. The Fed's now said, it's on and they're not going to save the market. So maybe we do just need a real dumping over the next few months, maybe slow, maybe fast. But that may be what we need to see before the Fed really pivots. And, I've always had that range, and I'm looking at the buy zone of that range, which is sort of down here somewhere. So, that's sort of still how it's going. Everything's sort of pointing in that direction. What we need to see to get bullish, I'll just show you. So here's the weekly, and, we're looking at this downtrend, aren't we? And just really analyzing that. In the short term, we're looking at this weekly buy pivot, and we did see a week of buying, but that, that might be it. There's just so much selling pressure above that, it just can't carry on with it. And if we're just looking at the downtrend, what are the lines in the sand? Just quickly, if I'm just sort of looking at this trend developing, I've got a new low. So really, it's above that wave is where you start saying, okay, this could then have quite a spike going to retest near the all-time highs and that sort of thing. But as long as it remains below there, which is up around 4,300, 4,350, as long as it remains below there, you're staying on a sort of a negative footing. Even if this thing manages to find some buying and spikes, you're still really looking at this from the point of view of the longer term trend that is developing here, which you can see sort of like that. So that's really how I see it. Big picture, you're saying, yes, it can have these bear market rallies at any time. You've just got to accept that, that big picture is still negative. And just be wary after the Fed said what they've said, that we could still be in for a bit of a rough ride. So let's quickly finish up with gold, because they've come out and said they're raising rates further, quicker. They're not going to stop now. So real rates starting to increase, which is negative for gold. So you've seen this as this has developed. I've showed you, this is the monthly chart. There's the all-time high from 2011. So we've got this big correction in gold that happened where all the gold stocks got absolutely killed. So that's, a major correction. We've then had that work done, going and retesting that high, false break of the high, right? And that's been the correction that we've seen for the past few years. So if I'm just looking at this from the point of view of this correction, and we're breaking down below that low. Where are your targets? It is sort of back to that midpoint. point of control, that's down at 1485 for starters. So that is where we could be heading. There's a few ways you can look at this, and I just want to show you those different methods. They all sort of combine, really. And another way of looking at this is we've got this wave structure here. And really this wave was a huge, strong up wave. And look, you can either take that wave from there or just this really impulsive wave. I don't think it really matters which one you look at there. But the way I'd look at it is, it's been such an impulsive wave without much, let's just take this one, without much of a correction, really. So if I'm looking at that wave, the waves usually have quite large corrections, as you can see here, big correction which shakes everyone out. And again, lots of shaking out going on, retests of the buy zone of waves. So, no reason why this can't surprise to the downside before finally heading back up, just a real shakeout. And also I'd be looking at the range of the most recent correction, which you can see there. So there's lots of positions have been built up in this range, and this is a few years of trading. So when you break down below that low, there's a hell of a lot of stoppies that are going off, and that's sort of going off now. And I've got areas outside the range where reversals often happen from. So that's 25% outside the range, and I can't even see what that number is. I'll figure it out in a second. And 618, the 61.8 Fibonacci level outside. So that's down at 1435, and this one's just below 1600. So really that area, if it is going to be supported, it could end up just having a clear out to there, but we'd need to see the false break of the low, and then we could get excited. Or with rates going higher and nothing really helping, and gold right on the edge of that low, it may need a real clear out, and that would take it down to what, 1435. 1485 was the point of control of this whole range here. So that could be a possible target for gold here. So gold stocks may not recover yet for a while, but that could be the buy of a lifetime. You never know. Down there, once it's had the real clear out, and things start softening off again with rates, etc., etc. So that's how I see gold looking a bit of a worry down here near these lows, and could have further to fall than most people think. So that's it for today. We are entering a pretty interesting time with those rates really flying higher, that big negative yield curve. Now markets expecting that the Fed is quite determined to keep raising rates, and people thinking they're probably going to overshoot. And the Fed themselves saying, look, we can overshoot because we've got the tools. I mean, we can then lower rates. But if we undershoot, then inflation could become entrenched. So they actually seem to want to overshoot rather than undershoot at the moment. So that's going to cause problems, but will cause big opportunities down the track, as long as you're still standing once the dust settles. So that's it. I shall come back with more next week. Cheers.